this presentation, we will record the automobile on our personal QuickBooks file using a simple method. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are in the home page. We currently have the open windows open. We can open the open windows by going to the View drop-down and selecting the Open Windows list. We're now going to go to the reports and take a look at the balance sheet, taking a look at the reports drop-down, scrolling down to company and financial, and then down to the balance sheet standard. We've been entering information into the balance sheet for the year of, changing the customized reports up top to 01/01/20 to 12/31/20. That's January 1st to December 31st, 2020, the year we are working on, changing the fonts from wherever they are at 8 to 11, and OK, yes, and OK. So we've been entering our data into the system according to the bank statement, and then we've been adding to it items from the balance sheet, which we would have to put in that could have been from transactions prior to when we started entering information into the bank statement. Now we're going to add the automobile. That's a common type of item that we purchased possibly prior to when we started entering the data. We want to put it on our system so that our balance sheet reflects an auto of some type so that we can look at a more accurate balance sheet of where we stand at this point in time. So the auto is typically going to be a fixed asset. It's not something that we can spend or use to buy other stuff right now, and therefore we want to put it under kind of fixed assets on our personal balance sheet somewhere. So let's think about how we're going to do that. First, we got to think about, well, what's the value of the automobile that we need to put on the books? And to consider that, we can say, well, we bought the automobile, let's say for $20,000, and maybe we financed the automobile as well. So we might have two kind of things that we got to put on the books. If that's the case, we'd have to put the automobile on the books, and we'd have to put the related loan on the books. So you can think of those as kind of two separate items that we need to put on the books. If we put the automobile on the books, we could put it on at the purchase price, the cost, but we know that of course the current value is much less than that at this point in time. So what we'd have to do is write it down to something that it should be at this point in time. Usually we do that with what's called depreciation, and we do a separate account, a contra account for depreciation. We write it down. But if we want a more like appraisal type method just for our personal finances and just have less kind of accounting lingo in our financial statements and just try to get to the bottom line, then we might say, okay, I looked it up on the Kelley Blue Book or something like that. I bought it for $20,000, and I believe now, as of December, it's worth $14,000. So let's say as of this time that we started entering data into, January of the current year, we're going to say it's worth $14,000. So December of the prior year to it, or January of the current year we're working on, we could say, okay, we just looked it up and we're just going to put it on the books then for what we believe the current Blue Book value is. That's one method. That's kind of the simplest method we can do to just enter this on the books. So let's see how we can enter that into the system then. So if we go back to QuickBooks, we want to put the automobile on the books, but no cash is affected. So how can we enter that into the system? We could use journal entries, or we could use registers. We'll try to use the registers so we don't have to think about debits and credits. We'll do a similar method as we did with the home, setting up first the automobile account as an account, and then adding it to that register. So the way we could do that is go to the Lists drop-down, Chart of Accounts, Lists and Chart of Accounts that was, and then we're going to add a new account by going to the Account Drop Up at the bottom. Account Drop Up, we're going to say New Account, and it's going to be a fixed asset type of account, a major purchase, large item. So we're not purchasing it right now, we're putting it on the books as of now. So we're going to say Continue. And then we could just call it auto. So I'm going to call it a fixed asset, auto, automobile, car, whatever we want to call it, truck, if we have a truck or something like that. And I'm not going to put the opening balance in because QuickBooks will then put it to some other location. We could use that, but I'd rather put it in to the register and determine where we want QuickBooks to put the other side of the transaction. So we're going to say Save and Close, and there we have our account. Now I'm going to go into that register by just double clicking on it. Now we're in the register, not the check register, but that car register. And I'm going to put in as of the date of 12/31/19, the year before, the day before the year we are working on, 12/31/19. We're going to enter this transaction into the system and just put it on the books, not at the purchase price, but the blue book value. Again, this is not generally accepted accounting principles. This is us trying to give ourselves personal information. So we're doing just personal data here in kind of a simplified method, less accounting lingo. And then we'll talk about a more complex method on how to put it on according to depreciation. So we're going to say that this is going to be an increase of 14,000. And then the other side has to go somewhere. And I'm just going to put it to equity. Now, because we put it as of the beginning of the year, we could put it to the income statement. And because we put this in the prior year than the year that we are working in, if we put it to an income statement account, it would roll into equity anyways, and we would be okay. But even if we entered this in the middle of the year, and we had already entered data, if we take it to the equity in our personal file, it won't be affecting net income. So I'm going to take it to owner's equity and just say, okay, and it's hitting the retained earnings account, that's okay, and there we go. Now if we go back to the balance sheet, what happened? We've got the automobile on the books for 14,000, and the other side is going to equity, which is the book value of the company. So if we have an auto, then the equity should be increased by that auto because it's ours. That's part of our net worth. Equity represents our net value, our net worth on a balance sheet statement. If we have a related loan to it, then we would want to put the related loan on the books. And it would not be an asset, but a liability. It'd be down here as a liability, and the other side will go to equity as well. So let's say that as of this point in time, we had a blue book value here, and we're saying that the loan balance is 6,000. So we'll say the loan balance now is 6,000. So now we have to put the loan on the books. Same method we'll use. We'll say, all right, let's go back to our QuickBooks file. We're going to add a new account. We're going to go to Lists, Chart of Accounts, New Account down below, New Account. And we're going to make this a liability account or just a loan account. And then say Continue. And then we're just going to call this Loan-Auto. And we might want to put a loan number on it, but if we say it's our only automobile loan, that's probably enough detail. We want to make sure we can differentiate it from other loans. Not going to enter the beginning balance here for the same reason. We're going to say Save and Close. And then we'll just go into that auto loan by double clicking on it, going into the register. This being the register for the loan, not the check register. And we'll enter the same date, 12/31/19, the day before the year we're entering data into, the day before we're starting the data input for our system. And this is going to be 6,000 increase in the loan. Make sure you're on the increase side. Sometimes they flip these two names, the increase and the decrease, depending on the type of register we're in. This will be then the 6,000. And then the other side is going to go once again to equity. So we'll select the drop down. If we did choose an expense, because we're choosing the day before, it would still be okay because it would roll into equity anyways. But even if we were in the middle of the year and we chose equity, then it would be okay because it would not affect the income statement. So we're going to say yes and okay. If we go back to the balance sheet now we've got our auto loan on the liability side. So we've got the auto on the books, which increased our book value, the value to us, kind of our book value, our net worth on the balance sheet. And then we got the loan that increased on the liability sides, which decreased our net value. So if we look at what happened to the owner's equity account then, and I changed the date back to the prior year, 19, 11 would work too, but 19, and we have these amounts related to the loan, the 6,000, and then the auto. So they net out against each other. So we have a net increase, the difference between the two. So we'll close that back out. And that's the simple way we can get the auto on the books. Now, if we want to check the auto every once in a while, we should, write it down every month and say it decreased in value, but we don't know exactly what it decreased in value by. So we might just go to it every once in a while and say, hey, is that auto really worth 14,000 anymore? I should decrease it to whatever the current blue book is, whatever I think it's worth now. And we typically want to be more on a conservative basis here just for our own thinking so we don't, overstate things. and make decisions based on the overstatement. But in any case, let's say that as of end of February, it's 10,000. Well, how can we make that adjustment then? Just to make our balance sheet right and not kind of mess up on the income statement side or do anything to the income statement that would be difficult for us to deal with or distort net income. Well, we can go back to our accounts and no cash is affected. We just determined that that's too high. It's down. Our auto's worth less now just because of depreciation. So we can go back to our auto account. We can go to our chart of accounts or just auto that we currently have open. And we could say as of the end of February, 02/29/20, there's a decrease. And we're going to say that it's going to go down. It's going to go down, and we said it's at 10,000 now, so it's going to go down by $4,000. And so now we need to know what the other side will be. Now we have a couple different methods here. The most proper generally accepted accounting principle, if this was a company, would be to recall this as depreciation expense. But that could be a little confusing if we're on a personal side and we're just kind of doing this periodically as we know that our account's going down, because it might be a few months before we write the expense and it'll skew our net income. Plus the word depreciation might be something that we are not familiar with. So we may not want it on the income statement at all. And if we do have it on the income statement, we may not want it called depreciation expense. Because again, from a personal side, we're probably thinking of our income statement as more of a cash basis budgeting type thing. And the fact that depreciation expenses there doesn't really affect that cash basis decision making. The only reason I'm writing it down is kind of for the balance sheet. So then we could write it to the income statement and put it as something like decrease in automobile. And if we did that, then maybe we want to put it as an other expense, and that would mean it would go below the normal expenses. So if we put something like depreciation expense on the auto, I'll just call it depreciation for now. Depreciation auto, that just means it's the decrease in value of the automobile that we're now recording. If we did that then, and we set this account up, I'm going to set it up, it's going to be an expense, but we might want to make it not a normal expense. We might want to put it an other expense, to put it on the bottom of the income statement. And we could say OK, and say save, and enter. And then if we did that and we then went to our balance sheet, we'd say, okay, that looks right. It took that down to 10,000. I can't see the original amount, but that's my blue book. It's on one line. I don't have too much detail. It's easy to see. The other side then would be on the income statement, going to the reports, company and financial, profit and loss. And we'll change the dates from 01/01/20 to 12/31/20. And now it's not going to be under normal expenses. It's going to be down here on the bottom. And that way I can kind of see my normal net income for budgeting. And then down here, this is this other thing that doesn't have anything to do with cash. That's probably not something I want to budget on from the personal standpoint. So here's kind of our net income before the funny stuff happened here that is me just writing down the balance sheet. So that's one way to do it so that we can see it on the income statement, even though and not have this distort maybe our planning number, which would be up here. The other way we can do it is to not put it on the income statement at all. We can go to our chart of accounts for auto, and we could just say, well, maybe I just want to have this go to equity. And so I'm just going to say, well, just draw it to equity. And then I can't see it at all. And I'll close this out, and we'll take it to equity. Then it won't be on the profit and loss. If we go to the profit and loss, it won't be there, which is probably good because it'll kind of confuse us on the private side, personal books. If we go to the balance sheet, then we're still at the 10,000. The other side has now been put into equity. So we just kind of took it straight to equity rather than through the income statement, then rolling into equity. If I want to see the detail, however, I got to double click on the equity and see the detail of that activity happening, decreasing equity. I'm going to close this back out. Now we might want to do the same thing we did with the loan here. If I don't mind seeing some more activity in the equity section, I could say equity/auto and record, the decline in value. And that's another way we can track it. If we want to take it directly to equity, I can make another account and say, hey, look, I'm recording this to equity to record the decrease in the value of the automobile, even though I haven't sold it yet. So those are kind of the three methods that you can use on a fairly simplified method, in that we're not going to have to calculate depreciation. We're not going to have an accumulated depreciation. or depreciation expense that's too confusing, we can just kind of write it down periodically and still be more or less on a cash basis, in that on the income statement we're not recording that accrual basis that's going to throw us off, and still on the balance sheet record what we believe the actual value of the automobile is. Next time we'll take a look at a little bit more of a standardized method where we'll have the automobile on the books and then the depreciation related to it and the accumulated depreciation related to it. Also note that the loan down here that we put on the books, we didn't have any payments in our example on the loans, but if we made payments, monthly payments on the loans, we would follow the same process as we did when we set up the home loan. So there's a couple different methods that we went in through with the home loan that we can apply those same principles to any kind of loan that we make on a monthly installment type basis. So you can take a look at that just with regard to the loan payments that we would make on a monthly basis. For more accounting information and accounting courses, visit our website at accountinginstruction.info.